Hello. Good morning. So yesterday we discussed the brief contents in SAPM, Security Analysis and Portfolio Management. Today we'll get into block 2, and in this we start with risk and return. Right. So hope you can see this screen. Right. So this block 2 consists of 3 units: risk and return, So the block 3 consists of 3 units: risk and return, valuation of common stock, and valuation of fixed income securities. So today we'll focus more on risk and return. So if you invest, the basic reason why we invest in securities is to get return on our investments. So these returns vary. These variations in the returns are called is measured in the form of risk. So every investment will come with the two important characteristics, return and risk. So every investment involves uncertainties that make future investment returns risk prone, right? So there are three things to know here: certainty, risk, and uncertainty. So if it is certainty, what does it mean? Is the probability of the outcome. The probability of event is one. If it is a risky event, the probability like yeah.
సార్ గుడ్ మార్నింగ్ సార్
Good morning, Anand.
సార్
చెప్పండి.
పర్లేదు సార్ చెప్పండి సార్ అది జాయిన్ అయినా
మీరు
సార్ అది ఆడియో ఆఫ్ ఉండే సార్
ఓకే మీరు ఆడియో ఆఫ్ చేయండి. మ్యూట్
చేస్తున్నా
చేయండి.
సార్ ఓకే సార్
ఓకే. So if it is a risky event, then the probability of the event lies between 0 to 1. And if it is uncertainty, we don't know the probabilities. That's how the risk and uncertainty are different. In risky situations, we know the probability of the outcomes. In uncertain events, we don't know even the probabilities. So every investment comes with the two important characteristics, return and risk. And return is the amount of money what we get. Say suppose if you invest 100, if you get 110 at the end of the year, 10 percentage is the return. But when I say, suppose if I invest in a government bond, if I invest in a government bond, if my investment horizon is 1 year, and if I invest in 1 year government bond, right, then what happens is, suppose if the government bond promises 5% yield, I get 5% yield at the end of the year. So this is certain. You know today how much return you're going to get at the end of the year. Right? This is 5%. So this is certain. And if you say, suppose if you invest in equity of any company, equity shares of any company, right? And if your investment is 1 year, right? Investment horizon is 1 year, and you don't know, right? The return what you get at the end of the year. So there is, you are supposed to assign the probabilities for these returns. Say, I have 20 percentage probability to get 10 percentage return. Say 70 percentage probability to get 15 percentage return, right? So maybe another 10 percentage probability to get minus 5 percentage. So this is a risky situation where you don't know the outcome, right? So every investment, right, our returns are risk prone, and the risk can be defined as the probability that the expected return from the security will not materialize. So what happens here? So you got these three possibilities or probabilities, and the expected return may be different from the actual return. So that's the reason why we call it as risky, right? So generally in finance, what we assume is higher the risk you take, you must get higher return, right? So this risk what you're taking must be calculated risk. And say suppose generally the government bonds which are less risky may give you 5 percentage on an average, and the equity may give you 10 percentage, and if it get into derivatives it may give you 14 percentage like this. So the risk what you're taking, right, generally in direct relation with the return, or the return what you're going to get is in direct relation with the risk. Higher the risk you take, generally you must be compensated with more return, right? Otherwise it's waste of the putting your efforts in taking higher risky investments if you are able to get only less returns. So that's what we discussed today, the risk and return, right? So in this we have the various issues, the types of risk, right? So as we discussed, right? So first we'll get into the risk, right? So we have two types of risk: systematic risk and unsystematic risk. Unsystematic risk. Then measurement of risk. So generally we measure risk using various statistical measures, but most widely used statistical measure to calculate risk is standard deviation. Then we get into return. What are the elements of return? Then return measurement. We'll see the risk return trade-off. So this is a brief about the topic what we are going to discuss. And just let me. Suppose if we see here this pyramid, right? So the different types of securities and corresponding risk. And if you see, the base comprises of government bonds, money market, bank accounts, certificates of deposits, notes, bills, bankers' acceptance, cash and cash equivalents. So these are all the the securities which form the base, and these are all the securities which have less risk, right? So if you see this pyramid, it's from low risk to high risk. The base securities, generally the government bonds and all, carries less amount of risk. When it comes to the middle part of the pyramid, it is real estate, equity mutual funds, large and small cap stocks, high income bonds, right? Even the bonds again. So if you're talking about bonds, should not be under the assumption that all the bonds are of less risky. So the bonds have various categories, and if you get into high income bonds, right? High income bonds or emerging market bonds, generally what happens is they come with more risk. So if you see the government bonds in the base segment, right? High income bonds or a high income debt, generally you see in the middle part, right? Then if you get into the top, the summit is options, futures, right? Or callable, puttable, right? All this comes in. Even another maybe if you consider cryptocurrency also as one of the investment alternatives, it comes in this part. It comes with high risk, right? So you should know, right, the spectrum in which the investment falls in, whether it falls in the base segment or middle segment or the high summit, because the as you're moving up, the risk is increasing, right? And so, as I mentioned, we have two types of risk: systematic and unsystematic risk. The total risk, what the investment comprises of, is the sum of systematic risk and unsystematic risk. Right? So, systematic risk is also called as market risk. Unsystematic risk is issuer risk. Right? So, systematic risk also called as general risk. Unsystematic risk is called as specific risk. Right? So why should we know this? Because every suppose if you invest in equity of a company, equity shares of a company, right? These equity share prices get affected because of the macroeconomic factors, which are in macro in nature, or which may be micro in nature, right? So when I say macro in nature, it is the risk which is arising because of the macroeconomic factors comes under the systematic risk. The risk which arises because of the company specific factors comes under microeconomic, comes under micro factor, and which comprises of unsystematic risk. Right? So when I say macro, right? So if you see here, directly associated with overall movements in the general market or economy, right? So suppose if you take the inflation, right? It's a macroeconomic issue, unemployment, GDP growth rate, right? Say maybe the per capita income, or maybe the currency fluctuations, wars, right? All these comes under macroeconomic issues, and the risk which arises to your investment because of these type of factors is called as systematic risk. And when it comes to micro in nature, then you can say the labor strike of a particular company, or the raw material shortage for that particular company, or any specific problem which is very much particular to the company, is because of this specific factors, we call it as specific risk or unsystematic risk, or it is very much related to issuer, right? So the total risk is the sum of systematic risk and unsystematic risk, and systematic risk generally arises because of the overall market movements, because of macroeconomic variables in nature, whereas the unsystematic or non-systematic risk generally because of the factors which influence the specific company. Right? So when I say this again, right? Suppose if you see here the basic classification, types of risk or the total risk comprises of systematic risk and unsystematic risk. Systematic risk is uncontrollable by an organization. It is macro in nature. Unsystematic risk is controllable by an organization. It is micro in nature. So when I say uncontrollable by an organization, because it is out of the limits. Say suppose inflation. When I say inflation is the risk because of inflation is comes under systematic risk. So what does it mean is it is uncontrollable by an a single organization cannot control the inflation, or cannot control the currency fluctuations, or cannot control the unemployment in the economy. So systematic risk and the factors which causes this systematic risk are out of the control of the organization, whereas the factors which are under the control, say labor strike, which can be controlled by the company itself, or raw material shortage, they can plan well and they can avoid the problem of raw material. So the factors which are under the control of the organization comes under unsystematic risk, which is micro in nature, right? So if you see the systematic risk, it can be economic conditions, political conditions, sociological changes. All this comes under the systematic risk. And if you see the 2007-9 credit crunch, which generally it happened in the US, right? We call it as subprime crisis, is because of the maybe the greediness of the American banks. So this is the one of the issues because of which the entire markets across the world tumbled. So this is a sort of an example of systematic risk, which cannot be controlled by a single company, right? So you can see the tech bubble, which happened in 2000, dot-com bubble. Right? This is again influenced or affected a lot of companies, which is out of the control of a single company. So these type of problems or these type of factors which contribute to the risk of the company, right, called as systematic. And if you see the further classification of the systematic risk, it can be the market risk, interest rate risk, and the purchasing power or inflationary risk. So this is what we have been discussing, right? So when we say the market risk, right? So what is this market risk? Is the variability in a securities returns resulting from fluctuation in the aggregate market, right? So whenever we talk about risk, it is the variability of returns. Let it be market risk, interest rate risk, inflationary risk, whatever. Whenever we say the risk, it should be the variability of returns. And this variability of returns we measure in the form of sigma, or we measure in the form of beta, right? But there must be variability of returns. Say suppose if every day you are getting 10 percentage return, if your stock is giving 10 percentage return every day, right? So we say that the risk is zero because there is no variability in the returns. Even if the stock is giving minus 10 percentage every day, the risk is zero because there is no variability. So whenever we say the risk, it must be accompanied by the variability, right? So if there is variability, then only the risk arises. So when we say market risk, right? It is the variability of securities returns resulting from the fluctuations in the aggregate market. Right? So, if the aggregate market is changing or is fluctuating, these fluctuations in the aggregate market will lead to the variability in the securities returns. So, if you measure this variability in the securities returns because of the movements or the fluctuations in the aggregate market, we call it as market risk. Right? So all securities are exposed to market risk, including recessions, wars, structural changes in the economy, tax law, right? Everything. Right? So every market, a macro factor influences the market, and when the market is getting affected, most of the stocks in that market gets affected. Right? So when it comes to interest rate risk, again you see this, Whenever we say the variability, right? Whenever we say the risk, it must there must be variability. So if there is a variability in securities returns resulting from changes in the interest rates, right? So if you've been observing, the Reserve Bank of India takes a call on CRR, SLR, right? So whenever they increase the interest rates or decrease the interest rates, generally what happens is this increase or decrease of the decision taken by the RBI will impact the the returns on the stocks. So whenever it is increased or decreased, generally there will be variability in the securities returns. So if there is variability in returns which is resulting from the changes in the level of interest rates, we call it as interest rate risk. And generally, these changes in the interest rates affect the securities inversely. Right? So, what does it mean is the security price is inversely related with interest rate. So, what does it mean is if interest rate if interest rate increases, generally the security prices decreases. If interest rate decreases, the security prices increases. The reason why, again, now maybe if you understand the valuation in a better way, so what happens is if the interest rate increases in the economy, right, what actually happens is the expected or required rate of return for the investors increases. When the required rate of return increases, say suppose I would like to calculate P0, which is P1 plus D1 by 1 plus KE. If this is the formula, then what happens is if the interest rates in the economy increases, if the interest rates in the economy increases, the required rate of return, this is the required rate of return. This required rate of return increases, and when the required rate of return for the investors increases, the stock price increases. So this is one of the reasons why the interest rates and the stock prices or the securities prices are generally inversely related. And the same thing holds good for bonds also, right? We have a theorem, bond theorem called inverse effect, right? Which states the yield on a bond is inversely related with the price of the bond, right? So whenever the yields changes, yield is nothing but the required rate of return. Again, when the yield changes, the price of the bond changes. If the yield increases, the price of the bond decreases. If yield decreases, the price of the bond increases. So interest rates generally tend to have